Hello everybody, it's Yashar here, back again with another video, and in this video I'm going to talk about EQ Bank stock. Andrew Moor, the CEO of Equitable Bank, recently participated in a live interview with a national bank analyst during a finance-focused conference. And he was asked a few challenging questions, and he provided interesting perspectives on recent banking system fiasco in United States, the risks of banking system here in Canada, and finally the future of EQ Bank. I will include 3 short clips of Andrew Moor interview in this video and provide my commentary on his perspectives. I will also discuss why I remain bullish on EQ Bank even though the stock recently had some weakness. I recently bought another 40 shares of EQ Bank during this dip, and now I own 200 shares and invested almost $12,000 in this company inside my tax-free saving account. We have a lot to cover in this video, so let's jump right into this. If we look at the fundamentals of EQ Bank business, their balance sheet, their profitability matrix, and their valuation, we see no sign of weakness. EQ Bank has an amazing track record of growing various aspects and sectors of their business, including their EPS, their book value, net interest margin, number of customers, the amount of deposits, all of them consistently year after year. Despite this explosive growth, they are still expected to grow their EPS by 10 to 20% year over year and their dividend by 25 to 30% every single year in the next few years. Their return on equity was consistently over 12% in the last 7 years, and on average, their return on equity is around 15%. Their net interest margin is 1.87%, and it is expanding, which means their profitability is increasing over time. They had an explosive dividend growth in the past couple of years, and this trend is going to continue in future. Their dividend payout ratio is only around 16%, which means there is a huge room to increase this dividend further in the future. Finally, they are trading below their book value at the moment, which is even historically is a cheap valuation for a fast-growing business, for a fast-growing bank like EQ Bank. Overall, I think EQ Bank has a great risk-reward profile, and that's why I continue to invest in this company. However, despite all these amazing financial figures that I talk about, in the last month, EQ Bank stock crashed almost 20% from $69 per share to lows of $54 per share. And now it is slowly recovering from this crash, and today EQ Bank shares were traded for almost $59. As you probably know, the reason we see this crash in bank stocks and particularly EQ Bank is the recent banking fiasco in United States, where 3 regional banks, especially Silicon Valley Bank, went under, and the US government and US Federal Reserve basically bailed out these banks and had to insure the deposits. A lot of investors panicked when they hear the news about banking system fiasco down the border and sold Canadian banks left and right. Between various Canadian banks, EQ Bank was one which had most selling pressure, probably because of their size and of course their exposure to fintech startups, Canadian real estate, and mortgage markets. The real question is whether or not Canadian banks, and particularly EQ Bank, is in some sort of trouble after this fiasco in US banking system. Andrew Moor, the CEO of EQ Bank, who is, by the way, the CEO of the company for almost 14 years now, participated in a live interview with one of the national bank analysts in Quebec, and he was asked the same question. I will leave a link to the full interview in the description box below, but let's look at this short clip and see how he responded to this question.
Let's start with the topic of the day, the regional banking crisis, or dislocation, maybe we should call it. Maybe first start out talking about why is EQB insulated from some of the factors that play south of the border?
But I think, first of all, Canada's broadly insulated from those factors. I think there's a combination of reasons for that. Good regulation, probably a more conservative culture, a much smaller banking sector, so it's probably easier for the regulators to keep an eye on us all. As James just mentioned, we're the 7th largest bank. And frankly, by the time you get down to sort of the 10th largest, you've dealt with anybody that could really create any sort of meaningful challenges. I think the other thing is we're a culture that thinks about managing banks effectively. So, we talk about 8 core risks, but what I always talk about inside the bank is the big 3. And the big 3 are credit, interest rate in the banking book, and liquidity. Those are the 3 that, as a chief executive of a bank or as a leadership team, you need to worry about. You need to worry about reputation and legal and other stuff. for sure that's important, but those are the big three you need to worry about. And we manage, Basel III forces us to manage interest rate in the banking book well. We actually run to about a 1-year duration of equity. Just to sort of primer on that, duration of equity is the first order derivative of the value of the book to interest rates. And we also kind of worry about a convexity, how fast is that number changing? So as interest rates have been moving a lot recently, we've certainly been super focused on that, the duration being the second partial derivative to interest rate. So what Silicon Valley Bank did in particular was like set themselves up poorly from that perspective. They had a lot of interest rate in the banking book, and then of course they had liquidity issues beyond that. Generally we've got very little in the way of commercial deposits, and the vast majority of our deposits are term deposits, so they can't run in a crisis. And those demand deposits we have are by and large 90% plus covered by CDIC insurance, so there's no reason for anybody to move money out of the bank.
So he basically mentioned 3 main reasons why EQ Bank will be isolated from regional bank incidents in United States. First, he mentioned strict regulations here in Canada for banking system. He mentioned that when you are one of the top 10 largest banks in Canada, the regulators basically look at everything on your book and make sure you have enough liquidity to cover any financial distress. This is 100% true. For instance, in terms of the risk management, common equity ratio is an important parameter for bank stocks. CET1 ratio basically compares a bank's capital against its risk-weighted assets to determine its ability to withstand financial distress. The regulator recently increased the minimum common equity tier 1 or CET1 ratio for Canadian banks, and now effectively from February 2023, the CET1 ratio requirement is set to be 11%, up from 10.5%. Second reason he mentioned is basically tied to the first reason. Andrew Moor mentioned the strong capital ratios of EQ Bank. And this is also true. For example, EQ Bank's CET1 ratio is currently at 13.7%, which is among the highest capital ratios even in Canada. The last reason he mentioned was that 90% of deposits in EQ Bank are CDIC insured, which means there is no way that customers lose their money even if EQ Bank goes under. And therefore, as there is no risk for customers, there is no reason for them to panic and demand their deposit back all at once. I think the 3 reasons he mentioned in this interview were actually pretty legit reasons as to why the incident in US banking system does not have much to do with whatever is going on in Canadian banking system. And particularly, of course, EQ Bank. Next, the interviewer asked Andrew Moor about growth avenues for EQ Bank and how they want to attract more customers and more deposits. Let's look at another short clip when Andrew Moor responds to this question.
Okay. Let's shift to the growth profile, most exciting part of the bank. You've launched into Quebec. We're in Quebec here right now. What are some of the highlights, and how is that progressing? What are the highlights and maybe some of the adjustments that you've made in the go-to-market strategy?
Well, I think first of all we wanted to come here and be respectful of being able to speak to Quebecers in Quebecers language. So we have a number of Quebec members of our team that are Quebecers who made sure the bank was presented as a bank that would resonate with people from Quebec. When we appeared on one of the popular Quebec breakfast TV shows recently, where the value of the bank was being promoted quite strongly, and all of a sudden the number of sign-ups tripled that day. Typically we're running about 40 new accounts a day in Quebec, and there seems to be a lot of enthusiasm for our offering, which continues to be an award-winning offering. So we won the award from Forbes last year for the best bank in Canada, which is pretty amazing, and this was a vote from our customers and how they thought about us. I even saw something on Reddit recently where somebody had written EQ Bank and there was a picture of a goat, which I understand means the greatest of all time, right? How we treated them with authenticity. So our kind of marketing in the digital domain and what we do, and the fact that you can move money around the world cheaper and faster than you can with the other big banks, the fact that you get interest on your everyday savings account, everyday banking account is absolutely a differentiator. And so we're feeling very strong, very good about the offering. And again, we're growing at a rate that makes sense. We're not trying to grow super fast to attract hot money. We're trying to make sure that people understand we offer TFSAs and RSPs and Savings Plus, our Savings Plus novel account. We've got great GIC offerings. You'll always get a better GIC rate than you would if you go into a discount bank's platform. So it's a really strong offering. we have a payment card now. We actually get cash back on your payment card. So, use it like debit, but you get cash back. So it's a really strong offering that we think is really setting us apart as the leading digital bank in Canada. I think we've got lots of room now to continue to kind of grow and accentuate that differentiation.
Okay. You answered my next question about the EQ Bank card launch, and it certainly sounds like it's going well. So maybe
just to give evidence it does actually exist.
So he basically discussed a few strategies that they have to attract more deposits. He mentioned their expansion plans in Quebec and how their advertisements are clicking with Quebecers, and they are basically right now adding 40 to 50 new customers every single day just in Quebec. He also mentioned they try to offer competitive rates on saving accounts and GICs. He mentioned they try to allow people to have access to new products and services faster than conventional banks. And finally, he mentioned new EQ Bank debit card, which is obviously he's really passionate about this product. Next, he was asked about the question about their technology and growth avenues that can come from how they run their business. Andrew Moor mentioned interesting facts about how they are fundamentally different from Big Five banks in Canada, as EQ Bank has already set up their whole banking system and database on cloud, on Microsoft Azure, in a modern fashion, in contrast to Big Five banks which have an old system and trying to establish some of their services on cloud.
All right. Moving on then, still on, I guess, growth, and I was kind of going back to some of your commentary around visiting Microsoft and seeing some opportunities to create value through that relationship. So I was wondering if you could expand on what are some of these value creation ideas for the EQ Bank platform and with that partnership in Microsoft.
Yeah, so we've got a really modern banking structure. So our core banking system sits on Microsoft's Azure cloud. So we're sitting on the public cloud. It's a very secure environment. There are 3,000 cybersecurity engineers work for Microsoft protecting the Azure environment. But that means, and we're the only bank in Canada that operates our core processing on the cloud. Many of the banks are moving components, but our whole stack is sitting on the Azure cloud. So I was down in Redmond, meeting with some of the senior Microsoft folks around how you really develop in an agile environment on a cloud-based system, and what it allows you to do is just move that much faster in your development cycle. So the things we're thinking about now, we don't actually have a small business offering yet in our EQ Bank platform, but now that we've got this kind of core cloud capability, our ability to quickly iterate and build new innovations that can meet the needs of our customers is driving down the cost of building the innovation and accelerating the time to market. And so, you'll see that manifest this year in things like the first-time home buyers plan that will soon be able to offer these new special tax advantage accounts. And these are things that we can do relatively cheaply and relatively quickly compared to other larger banks that have got legacy systems that you still have to kind of work your way through. So enabling that advantage, and then of course when we were in Microsoft, all the conversation around ChatGPT, what that might do to our chat functionality. So in particular, our aspiration is to offer the best NPS of any bank, Net Promoter Score of any bank in Canada. We think we're kind of close to the top as it is, but we really want to accelerate that advantage. So the use of artificial intelligence, particularly in the kind of chat world.
He mentioned that there are several benefits for EQ Bank with their on-cloud services. They can develop new features pretty quickly in contrast to Big Five banks, as they have already set up everything on cloud, so adding new functionalities should be much easier for them, and the time to market should be shorter for EQ Bank. As an example, he mentioned they are in talks with Microsoft to create their own chatbot on top of ChatGPT for bank customers, which is pretty interesting, I would say. So for the last question, the interviewer asked Andrew Moor about rising interest rates and the effect of these rate hikes on mortgage payments for EQ Bank customers. As you may know, EQ Bank is considered a B lender in terms of the mortgage lending activities. It means some of their customers may not have the most conventional type of jobs or the best credit scores. In these cases, you will need to pay a minimum down payment of 20% and sometimes pay more on interest rates for uninsured mortgages, carrying a higher level of risk. This is one of the most concerning parts of EQB business. The interviewer also asked about how much money they are going to make in time of renewing these mortgages, as interest rate is much higher today. Let's see how Andrew Moor responds to these questions.
Payment shock, or I guess maybe renewal shock is maybe the right way to think about it in terms of your business. Single-family residential mortgage borrowers are going to be facing pretty significant increases in their monthly payments. I've heard some other banks quantify that number, but it's going to be significant. So I was curious more on, how are those loans that have renewed at higher rates, how are they performing from a credit perspective? And I guess, also if you're re-underwriting or looking at loans today, how does that ROE compare to the loan when it was perhaps originally originated? And how does that compare?
Yeah, so the ROE question is fairly easy. Absent credit losses, we're going to be pricing at roughly the same spread as we would have on the origination. The ROE will be, the ROE after taking all the costs will end up roughly the same as what we always do. We generate a 15 to 17% ROE, have done year in, year out for 15 years. So we expect that discipline will be there. I always thought our borrowers would be fairly resilient in the face of a rising payment shock, and they've turned out to be stronger than I kind of could have imagined, frankly. So far, so good. Now, whether they're drawing down savings, whether some of our customers are drawing down savings and so on to make that happen, and whether we run our road, these are things we all need to kind of be aware of. But certainly feels like with unemployment, low unemployment, frankly, I think Tony Gravel was talking about unemployment being super low and the inflation pressures from that. So can we, all the time people have got jobs, frankly, they pay their mortgages. That's the evidence over years of history. The question is how far does unemployment rise with interest rates still being relatively high?
So he seemed to be surprised at how good people are handling these additional payments on mortgages. It seems they actually expected more financial distress and much more missed payments, but as he mentioned, things are looking good at the moment, and the main reason for that is low unemployment rates. He also mentioned they don't anticipate to make much more money in the time of renewal, as their margin will remain the same regardless of the prime interest rate. Overall, these were interesting points that Andrew Moor raised during his interview. When I was basically listening to this interview, I thought it could be a good idea to make a summary video based on this interview and share it with you guys. As I mentioned in the start of the video, I remain bullish on EQB even after the recent banking system fiasco in US. I understand the risks, but I believe EQB has an overall conservative balance sheet with enough liquidity. They have great management team which are focused on value creation for shareholders, and they have lots of great growth avenues ahead. Big six banks in Canada cannot take much market share from EQB, as EQB is pretty tiny and small in size compared to the big six. But EQB can definitely take market share from big six banks in Canada, and they already started this super growth cycle. There you are, guys. I hope you enjoyed the video, and if you enjoyed the video and you are interested to follow contents related to EQB or other Canadian companies, consider subscribing to the channel to see similar content. Always remember that the information in my videos are not financial advice for you to buy, hold, or sell these stocks. And you should always do your own research before making any financial decision. Thank you for watching, and I hope to see you guys in the next video. Farewell.